Now, today's trading takeout is effectively how to understand that the market is just a series of relative changes versus previous. It's a series of surprise, and that is what people are looking for. So on the previous gold trade, for example, that we mentioned, that is really just looking at the extent to which inflation perhaps is slowing down globally. And now we're looking at the reflexivity on the way back. Even if we look at, say, the ES from last week, or not from last week, from a couple of weeks ago, we can see that when Powell decided to speak, which was roughly here, okay, ignore this. This is just a punt of a little stupid paper trade that I put on. When he said here that his base case wasn't a soft landing, we saw the reflexivity kick in because the market here had priced in cuts. Oh, sorry, the market had priced in peak rates for roughly this period. When he said that, the market absolutely tanked. And we saw the extent to which the surprise or level of surprise affects the market massively. This is something that you always have to be factoring in, especially as we're moving into the rate cut cycle. How much is the market pricing in X event, but how much is X event surprised by Y data point? Okay, always focus on that. And then the big determinant is how long do you have to action that idea? If you've got a longer time to action that idea, that's perfect. If you don't, then it's more event driven, it's more intraday, intra-week. Then you have to be a little bit more nimble, have the position size a little bit lower. But these are always things that you can be looking out for. How much is the consensus disturbed by recent data point? How much surprise has been brought into the market?